good Monday morning. This is Dustin Hobbs with the California MBA. Welcome to another episode of Connect. Hope you're excited for a good conversation. We've got a great guest today. I'm excited to jump into the conversation with him here in just a minute or two. But before we do that, let's thank our sponsors over at Incelerate. Incelerate is the leading mortgage lead management, CRM, and engagement platform that helps lenders close more loans by increasing efficiency gains across sales, marketing, operations, management. And they've just earlier this year announced the first of its kind mobile app that they released. The groundbreaking mobile app features full lead management, lead distribution, click to call, inbound call routing, first call automation, and two-way compliant text messaging, and provides access to critical loan information without having to use a laptop or log into your LOS system. It also empowers loan officers by intelligently distributing leads, managing pipelines, prioritizing their day, automating best practices, and personalizing the borrower's journey, all from the mobile app. So for more information or to catch a demo, visit Incelerate.com. You can also catch our friend Josh Friend on LinkedIn. I'm sure he'd be more happy to set you up with a demo, or you can call the number listed in the description below. So before we get into the conversation, I want to toss it over to our CEO, Susan Milazzo, for this week's weekly update. Susan?
Thanks, Dustin. Hi, this is Susan with the California MBA. This week, I'd like to talk with you about our annual Legal Issues and Regulatory Compliance Conference. So for those of you that have joined us for this event in the past, we typically host this in December. This year, we are moving that to January 12th and 13th, and we'll be providing it in our virtual environment. So if you've joined us for some of our conferences over the summer, you know that we have an excellent virtual platform that we can execute these conferences with. We have lots to talk about from a compliance standpoint in California. So some of the topics that we'll be covering, of course, how the pandemic has affected your business, not only from you running your companies and taking care of your employees, but how you are reaching out to customers, either from an origination or servicing perspective. We'll be talking about CCPA and the new privacy ballot initiative that passed here in California. We also have included labor law topics, which have been very popular at this conference for the last few years. So if you want any of your questions answered about California labor law, we'll have a panel that's addressing that, as well as, of course, hot litigation topics, as well as look at what the new QM will look like. And we are very pleased to be joined by Commissioner Manuel Alvarez with the California Department of Financial Protection and Innovation, of course, formerly the Department of Business Oversight, our state regulator here in California. So if you are licensed in the state of California, this is a virtual conference you cannot afford to miss. We've got some great topics, speakers that are recognized nationally that'll be joining us to provide information on a wide variety of topics. Visit our website for information on how to register, or if you're interested in participating as a sponsor, there's information for you there as well. That's it for this week. Back to you, Dustin.
Now let's get into the conversation here. I am excited to welcome in Rich Andreano. Rich is a partner with Ballard Spahr, based in their DC offices. Rich is the co-chair, I believe, of their mortgage banking practice. He's also the incoming chair of the California MBA Legal Issues Committee and the co-chair of our upcoming Legal Issues and Regulatory Compliance Conference coming up this January. Welcome, Rich.
Well, thank you for having me.
All right. Well, hey, let's start the background. Let's find out who you are here. Tell us what got you into the legal field, what kind of led you into specifically the world of financial markets and regulatory compliance.
Yeah, it was an interesting path. I had always been interested in the law in general. Yeah, I thought about journalism and political science was always interesting, history and all of that, and that sort of gravitated towards the law. And really, when I came out of law school, what I was thinking more is the securities area, and that always interested me. And really, that's what I basically started doing. I ended up with a firm. I was in the DC office, but they had two main bases. One was DC and one was Los Angeles. And I was actually working with the Los Angeles group. They had a big financial institutions practice. So a lot of the clients were California-based institutions. And during the time, this is about the mid 80s, a lot of mutual savings loan associations were converting to the stock form. And so that's what I was working on. I was working on some of the securities partners doing that. But as we moved from the mid 80s towards the later 80s, it might recall back then, a lot of savings and loans started having a bit of financial hiccups, and
Just
that sort of put it, yeah, that put it into the mutual to stock conversion business pretty quick. Fortunately, some of our California-based clients were quite healthy, and they were actually expanding their operations, particularly their mortgage operations east, because they wanted, wanted to grow their mortgage business. So I wasn't doing the mutual stock conversions anymore, and the firm came to me and said, "Hey, we've got this partner here who's helping our mortgage lending clients. You want to work with him?" And to me, sounded like a good opportunity. He had been at the Fed, was involved in writing a lot of the Regulation Z provisions that still exist today. And so I thought this would be a good way to learn the industry and the federal regulation of it. So that was my entree in the later 80s to the mortgage industry, and here I am now.
Yeah, well, and I mean, you talk about a never-ending job now you've got with regulatory
Abs-
issues.
Absolutely, it is a dynamic area, that is to say the
That's the best
least.
way to put it. I think that's the best way to put it. Yeah, so I'm curious, what during this last year, obviously this year has been a crazy year for everyone. What's been maybe the biggest challenge for you, sort of navigating the pandemic environment?
Yeah, interestingly enough, for me, I know the work from home for a lot has been a challenge. For me, it wasn't, and it was two main reasons. One, I was used to working remotely, often being on the road a lot. And the second, although I have kids, they're grown, they're out of the house, so we don't have that school issue and keeping them occupied during the day. And I know, some of my colleagues who are younger and have that. That's a real challenge. You just have to be flexible working with their schedule. Uh, for me, though, the real challenge, personally, is when right after the pandemic, we were really in the beginning of it, and all of the legislation and executive orders and ruling started coming to deal with it. We had the CARES Act, we had all the work from home orders, we had are you an essential business or not, forbearances, all of these different things. So it was Congress, it was the states, it was Fannie Freddie, FHA, VA, and it was like it was a tsunami coming at you of changes, and keeping up with that was daunting. And pace is down now, but just I was doing my regular monitoring the industry, writing alerts and blog posts, but I wrote, I think it was over 100 COVID-19 related alerts based on all of those changes. So it was, I mean, I just remember back to March and April, it was exhausting. And that to me was the hardest. But I think the industry should pat itself on the back for how quickly it pivoted to work from home, doing closings and working with their customers, making sure people got their loans closed on time. Industry did a fantastic job, and we firm kept going around saying, "Well, is the industry okay?" And I said, "Mortgage industry's fine. They really pivoted well. Interest rates are low. It's going like gangbusters, and much better than a lot of businesses. So I think the industry really deserves a round of applause for how well it's handled this."
Yeah, no, I agree. I mean, even just in this podcast here in the past year, every lender I've talked to, I've asked the same question, how are you guys dealing with the pandemic issues? And every one of them to a person is, without blinking said, we pivoted pretty quick to work from home. It wasn't that big of a deal. We just kept right on going. So I think you're right.
Yep.
Yeah.
Yep.
So
Indeed.
let's maybe back up here a bit to because certainly this year has been crazy. I mean, for me at least, maybe it's just me, but the CARES Act feels like it was 10 years ago.
Indeed.
It's been quite a year. But regulation in general, I'm curious your thoughts on, if we back out just a bit, zoom out, maybe what has been perhaps the most underappreciated law or regulatory action or case that's had a major impact on the industry, maybe in the last like 20 years.
It's actually a case, I think, a little more recent. It was decided in 2016. It was a case of Spokio v. Robbins, and really involved with Spokio and whether they had accurate information about this individual on their site, and they were deemed a credit reporting agency under the FCRA. And basically, though, the case centered more on what does a plaintiff have to allege to get themselves to have standing under the U.S. Constitution in federal court. Because a lot of times we get plaintiffs saying, "Hey, they violated RESPA, I'm suing." They didn't necessarily allege they were harmed. They just said, "There's a RESPA violation, I'm suing." And what the Supreme Court came down and said, Now, you just can't allege a statutory violation. You have to allege that there was a concrete and particular injury. In other words, concrete, it was real, wasn't speculative. In particular, it affected you.
Yeah.
And they decide in this case, the plaintiff had not really done that, and that the Ninth Circuit had not fully applied the standard. So it reversed the Ninth Circuit's decision and basically said that merely alleging a violation of a federal statute doesn't get you into federal court. And that we've seen now more recently, that probably one of the most recent ones, a case that had been going on for a long time here on the East Coast, where some plaintiffs, they were solicited by a lawyer to bring a class action lawsuit against a real estate team. It's case I think was Bear versus the Craig Northup team. And it was a team of real estate agents. And the allegation was that they had a referral arrangement with a particular title company. So they were alleging a RESPA violation. What they did not allege is harm in the way I was overcharged. They didn't say we were overcharged. What they basically said, they were denied the opportunity to a free market where there wasn't steering and you could be free to shop. So it was this kind of ethereal claim. District court said, no, we're looking at Spokio, not enough. Goes up to the Fourth Circuit, and the Fourth Circuit agreed. They said, no, that's not enough. You didn't allege harm. You have to allege harm particular to you and a real harm, dismisses it. So I think this case will be very helpful in defending a lot of cases, particularly where lawyers try to bring these class actions and they find a plaintiff and they find something that, if true, could be a RESPA violation, but has anyone suffered any harm? And so I think it's going to be very key to knock out some cases at the motion to dismiss level, because that's what it is. If you don't make it, the court doesn't have jurisdiction, so it has to dismiss the case. Now, this only applies at the federal level, doesn't necessarily stop someone from going to state court, but litigators in my firm say a lot of state constitutions have the same language in their constitutions that the Supreme Court's decision was based on. So the result often should be the same in state court as well. So that's, I think, is a very helpful development, that it was picked up, but it didn't necessarily get the attention, for instance, of the PHH case, which got a lot of attention.
Yeah, I mean, I would think just for the keeping down the volume of cases in general, that's got to have a huge impact that we, like you said, we probably don't, fully appreciate it yet.
Yes, indeed.
So let's see, you mentioned PHH. Let's, switch our gaze back to the CFPB. Where do we stand right now with the, legal challenges to the CFPB itself?
There are some ongoing challenges, but I think the potential for the biggest impact is a case that actually doesn't involve the CFPB. It involves the Federal Housing Finance Agency, and that's Collins versus Mnuchin, where that's gone up through the Fifth Circuit, and they held the entire court that the structure was unconstitutional, surprisingly, because the director was only removable for cause. Somewhat similar to the Bureau, but not exactly similar. The Supreme Court has agreed to hear that case, and there will be oral arguments. I think they're on December 9th. And the interesting thing, though, in the Seala Law case decided earlier this year, where the court was ruling directly on the constitutionality of the Bureau, the only issues were, is the Bureau constitutional or not? And if the structure is not, what's the remedy? The court ruled it's not constitutional. The remedy was the surgical remedy. The director becomes removable at will rather than for cause. They didn't address what is the ramification of that on prior CFPB actions. Yeah. The Collins case involves that issue because the Supreme Court, accepted both the Treasury Department's petition to hear the case and the Fannie Freddie shareholders petition. The shareholders petition addresses actions taken by the FHFA, and if it's deemed unconstitutional, whether the Supreme Court has to set aside those actions. So potentially, should the Supreme Court rule FHFA is unconstitutional and decide that affects its past actions, that's going to have direct implications for the Bureau. That really could result in chaos, which is why my guess is, courts don't like chaos. So the thought is the Supreme Court would probably try to avoid a decision that created chaos. Now, a lot of people have assumed, well, they're going to hold the FHFA structure unconstitutional. And I say, I wouldn't go there, because even in the Seala Law arguments, of course, the Collins versus Mnuchin case came up as as a relevant case and what the court thought of that. And I remember Chief Justice Roberts made a comment, and you always, reading comments during oral argument, just sort of like reading tea leaves, but it pretty indicated he didn't necessarily think the FHFA and the Bureau were identical, that he senses that the Bureau was much more powerful, so the four cores removal provision for the director there was much more of a concern than perhaps with the FHFA. Strangely, the Fifth Circuit thought the FHFA was much more powerful from the Bureau. And it so gives you, it's in the eye of the beholder what things are. Obviously, in our industry, FHFA has a lot of power in a narrow area. The Bureau has expansive power in a broad area. And it's hard to deny to us, the Bureau clearly has greater power. So I'm not sure the court gets to the same place, but if they do, and we'll listen to the oral arguments, it's going to be interesting to see how they might rule.
No kidding. So if they're hearing arguments in December here, when can we, theoretically expect a ruling? Would that be like waiting until summer to get the ruling, or?
Yeah, the court normally ends in June, although in some years more recently, they've had so many things, opinions have drifted into July, actually. The major opinions, because they get considered and they really think and spend their time writing them, tend to come out later. So the fact it's not being argued until December, I'm looking at probably a June timeframe for that, because it's a significant ruling. Constitutional rulings are pretty significant, and they like to take their time with those.
So if you're a compliance officer at a lender, maybe you don't take June or vacation in June or July.
Yeah, that's going to be a big one when that one comes out, because it could have broad implications, not only for FHFA but for the Bureau itself.
No kidding. Yeah. Well, so if we're looking at CFPB in general, and we're saying this, we're filming this here on a Friday. And we still don't quite know. It sounds like that we're likely to get a President Biden, but nothing's for sure yet.
Right.
But how would you anticipate the CFPB's agenda, looking next year, depending on if we have a President Biden or President Trump?
Either way, I think that the two of the main things for our area are the two QM proposals. The proposal to revise the general QM from the current very strict 43% debt to income ratio and that appendix Q, which is woefully inadequate to assess debt or income, and to replace that with a loan pricing construct. It's got a proposal, had a few points in it that need fixing, and the National MBA in its comment made some very good comments on that point. Again, advocacy is very, very important. And then the season loan QM will create an entirely new category, which basically, if a fixed rate loan that had the standard features for a QM had a good payment history, basically good payment history for 36 months, it would, regardless, it would become a safe harbor QM, regardless of what it had been before then. Now, I think those will be key focuses. The difference will be who wins president. If Trump were to win, I think you see both of those proposals adopted, though the Bureau asked for a lot of comment on variables to the proposal. So even if Trump is reelected and Kraninger stays in, the final rules may differ from what was proposed, because they did ask for a lot of variables, and I wouldn't even be shocked of a reproposal if they come up with some different paths to go down. I think they understand they got to get this right, and so they're trying to be careful. If Biden wins, however, I see a different path. The consumer groups very much don't like the season loan proposal, and I wouldn't be surprised if they pull that back and take that off the table and just don't go forward with it. Then with the general QM, might they go down a different path? Might that affect, do they go with the loan pricing construct? Do they go with some of the variables that would maybe combine loan pricing plus DTI? I could see something that might add more restrictions to be consumer protective, but they do, I think the Bureau would even understand in a Biden administration, because in the Cordray, when he was in as director, realized there was that need for the GSE patch, and without it, that could really cause harm to the industry as that was transitioning out of the mortgage crisis. I think there's a belief at the Bureau today that the current QM just doesn't work, and if we're not given something better than that, it's not going to work for consumers when the patch finally goes away. So I think there's an understanding, regardless of whether Trump wins or Biden wins, that what we have now doesn't work and we need something better. I think in a Biden CFPB, it would probably have more consumer protections built in than it would in a Trump CFPB.
Yeah, well, and you would, and I would imagine that, assuming we have a President Biden, then, CFPB's later year priorities or 2022 priorities completely change, obviously, at that point from, a President Trump.
Very much so, yes.
Yeah. So where are we at? You mentioned the QM patch. Where are we at with that? What's, for those who aren't caught up to speed on it, where are we at with that, and what impact should lenders expect in the coming year?
Yeah, I mean, when the ability to pay rule, and it went through, the original rule went through a few iterations, because after they put out the original rule, they had, I think it was 3 different amendments to it before it went effective. And one was to add the patch, because Cordray came in and realized that wasn't part of the original proposal. To his credit, he realized they needed something to transition. So at that point, rule comes effective January 10, 2014. We had the GSE patch, which would sunset if Fannie Freddie came out of conservatorship. We knew back then that wasn't going to happen anytime soon. I still don't think it's going to happen anytime soon. But the other date was January 10, 2021, which seemed way off in the future. Well, it's around the corner, and the Bureau realized that to avoid market uncertainty, that thing needed to be extended. And so in June, they proposed, actually, I thought they took a little time. I would have proposed, a year ahead of time to extend it. They proposed in June. In October, they did extend it. Extended when? It depends. It's sort of indefinite. It's tied to whenever they adopt the new general QM, applications that are taken before the date that the old QM goes away, will still be able to rely on the patch. The way they had originally proposed it, there was going to be a gap period where if a loan didn't close by a certain time, it can either rely on the patch or the new QM, and they fixed that in the way they extended the patch, so that basically it'll be available to the date for applications taken up to the day before the current QM is no longer available, and the only other one was whatever they replace it with. Interestingly, they did say they were considering perhaps a concept that the Fed used to use. The Fed, with a lot of truth in lending rules, would have an effective date and then a later mandatory compliance date, often 6 months later. And what that allowed you to do is you could implement a rule on a pilot basis, perhaps in one branch or one region, flip the switch and see if everything doesn't blow up or not, and you could test it, work it out before you expanded it to your entire operation. We've encouraged the Bureau to do that for we said, look, it improves compliance. If you allow us to test on a pilot basis and there are unexpected errors, it'll be limited and we can fix the errors before we go live through the entire company. They said they might do that. They're still thinking it through, and obviously the industry is going to recommend that they do that approach.
Yeah, have a little bit, and give it a little more clarity too there.
Yep.
So I'm curious, just kind of going into the next year, if you're a lender, what can I do if I'm sitting here watching? I'm saying there's all this uncertainty right now, and who knows what's going to happen next year, and I've got all this coming down with the patch and everything. What can I do to prepare for 2021? Maybe like a top 3 things I should do to prepare.
There's a few things I think people need to look at, and there's this perception that the Kraninger-led CFPB is doing nothing. And while I do agree in some settlements the dollar amounts may be less than they were in the Cordray years, that doesn't mean that the Cordray years were right and the Kraninger years were wrong. You could debate that, but the Bureau has been quite busy in certain areas, particularly 2, and there's some relation because some involve marketing. One is, though, redlining, fair lending in general, but redlining. And we now have, they filed in July, the first ever redlining complaint against a non-bank mortgage company. It's always been banks or depositories. Now we have one against a non-bank, and then they followed that up, noting in their supervisory highlights that came out in September that in examinations at the end of last year, they cited both banks and non-banks for redlining violations as well. So, and we know, we had a few that we were handling. Fortunately, that ended up well for the clients. But it is an area they're focusing on, redlining, and particularly in the non-bank areas. So there you look at things, they did the standard analysis. Is what is your outreach and marketing? Do you really trying to reach all areas of communities where you lend? What do your loan officers look like? How many applications, when you lend in a community, are you getting a low number of applications from minority areas of that community? Are you not making many loans in the minority areas of those communities? They're looking at these things. So one thing I would do is I would do a fair lending analysis, or in particularly a redlining analysis. And one is, the statistical firms can do this. They can compare you to peer institutions and see, are you an outlier? Because you don't want to be that's key. You don't want to be an outlier. If you're an outlier, then you're at the top of the list to get looked at. And so do your own assessment, make adjustments to be better, to better position yourself, and look at your advertising. One thing they said, a lot of that advertising is the models were almost all white, or the loan officers in the ads were almost all white. That is a red flag to the Bureau. And so these are simple steps you could do to reduce the likelihood. Another thing the Bureau is doing, and involves advertising as well, as you know, there's been a lot of concern with the churning of VA refinance loans. So we had the Growth Act that put in some limitations on that. The VA's issued some guidance to put further limitations. But believe it or not, the National MBA went to the VA and said, hey, we're noticing some direct mail marketing practices that really give us concern. Frankly, they thought they were deceptive. VA got that. It got the Bureau involved. Started in July, the first consent order. We're now up to 9 consent orders against lenders for direct mail VA refinance loan marketing. And they're on the Bureau's website. You can go look at them. But basically, they were looking at Reg Z. Yeah, they were technically non-compliant with certain Reg Z, but what bothered them more was Reg Z and then the Mortgage Act and Practices Rule, MAP rule, have a lot of unfair, deceptive type of advertising prohibitions in them. That was of greater concern. And they also use their UDAP authority under the Consumer Financial Protection Act at what they thought was various misleading practices. Particularly, one thing you can't do is suggest affiliation with the government. They took a very, very broad approach to that, where you read some of the things and you say, wow, that's pretty expansive view of what's government affiliation. And they even had some of the lenders agree, and they admitted this isn't the law, but this is the terms of the consent. Some lenders couldn't agree, use a long list of terms. One of the terms they couldn't use is VA loan specialists. Now I have clients that specialize in VA lending, and they think they're VA loan specialists. So I would look at these consent orders and look at how, what you're doing. I'm sure a lot of companies aren't doing what these companies are doing, but it gives you an idea of what the Bureau is looking at and what they're worried about. And the thought is they may not end this at this, these direct mail VA refinance. They may take this and say, is anybody else doing this in other areas of lending? So I would check my lending practices in general, because they are focused. And the one thing I think, particularly under Biden, CFPB, what we would see more of is the use of their UDAP authority, because it is very expansive. And that's when they often think there's true consumer harm, when people are being misled or abused or treated unfairly. That's what I think the Biden-led CFPB will really focus on.
Yeah, well, that's a lot. If I'm a lender, that's a lot to think about. But that's good advice, I think, for preparing for either a Trump or a Biden administration going forward. So we've got just a couple of minutes left here. I'm curious to pick your brain on this. You mentioned advocacy earlier. How, and this is sort of I would freely admit this is a bit of a softball question, but I think that hearing from you on this is important. How important is advocacy work right now, particularly at either at the federal level with the MBA or here in California with the California MBA?
They're both extremely important. And just looking back, and I alluded to some of these, what with COVID-19, as the shutdown started coming, both the state and national MBAs quickly pivoted to make sure these shutdown orders make sure that our mortgage companies and the vendors, like the title companies, the escrow agents, the other people we need to work with, were all deemed essential businesses. That was and there were some revisions to some of these executive orders because of that advocacy. Then the work at home orders. We need to work remotely from unlicensed locations, coordinating with the states, the CSBS, to get that guidance where it needed to be. Then for the states that didn't have remote online notarization or similar, to get at least temporary remote online or remote ink sign notarization or similar laws in place so we could do our closing. And then when the CARES Act came along, getting some industry concerns noted there to make, because some of the original proposals where you were going through this whole complex procedure to determine if someone was qualified for forbearance, and having been through TARP, and all of the various laws from the mortgage crisis, where they said, guys, you're making it too hard to determine if someone qualifies or not. We can't process thousands and thousands of applications, overnight. The industry really said, this needs to be simple. It's got to be simple to determine if someone complies with a forbearance. We don't have the capacity with the number of people that are going to need this to go through a long application process. So that actually, they took these very difficult proposals, they made it simple. Then when the states started considering it, the advocacy, hey, state, carve CARES Act loans out of your statute or your rules so we don't have two sets of standards applying to one loan. All of that was extremely important and will remain so, because there's going to be another round of legislation. The CARES Act didn't address the final resolution of these loans in forbearance. What are the loss mitigation options? It's in the HEROES Act, which was passed by the House. That's going to have to be considered, and advocacy is going to be important there. And the states, they're going to consider their own ultimate loss mitigation provisions. So it's making sure that they understand the concerns of the industry and that whatever's imposed on servicers is reasonable, and that it's understood that a lot of these advance obligations were unreasonable, and a lot of advocacy by the industry got the FHFA to step up and have Fannie and Freddie really take on and Ginnie take on some of those advance obligations after a while. So this demonstrates how important it was, and the industry would have had a hard time operating without that advocacy. And it's going to be more so, particularly if we move into a Biden administration. The House has a lot of things on its plate. Maxine Waters has a lot of plans. Obviously, if the Senate stays Republican,
in the news again.
But they have a big agenda now. The Senate, depending on where it goes, that may be a roadblock to a broad agenda. But we think we're moving in an area where we're going to need to have our points being made at both the state and federal level. I know a lot of people think, well, it's really the federal advocacy that's more important. I said, oh no. The states really now have stepped up, and particularly California, which has a very busy and aggressive legislature and governor. Advocacy is important to make sure our voices are heard and our concerns are known, and how a lot of proposals that, while on their face appear to be helpful for consumers, in the end actually will harm consumers because of the costs it will impose on the industry, which will just get passed on to the consumer.
Absolutely, yeah. And when I couldn't agree with you more about California. I mean, I think every state legislator and every committee chair would bristle at the thought that all the focus should be on the federal level and not on what's happening at the state level, because they are quite active here, as you mentioned, and they will be certainly in 2021 for sure. So
absolutely.
Rich, thanks again for your time. This is really good conversation. I think we could have kept talking for a while here. I really enjoy the sort of the change in pace from talking about whether it's mortgage tech issues or talking to lenders about their experiences. I enjoy talking about what's going on in the legal and regulatory compliance environment. So thanks again. Enjoy the conversation.
You're welcome. Thank you.
And if you enjoyed this conversation, make sure and subscribe to us here on our YouTube channel. You can also find us on Spotify, SoundCloud, Apple Podcasts, and we'll be back again next Monday for another episode of Connect. We'll see you then.